After a good run on Friday, gold is back below 1,200 an ounce this Monday. Joining us to talk about gold's ups and downs is Frank Holmes. Frank, good to see you.
It's good to be here. And I think we're going to have to live with this sort of plus $50 to $100 and minus until we come to June, which historically starts the seasonal pattern off. But I think the big part is looking in Germany last week. The German bonds, the 5 and 10 year hit all-time negative lows. And so the U.S. dollar looks so strong when you see what their interest rates are today. 5 and 10 year bonds are positive rates of return. I'm impressed. In fact, the gold is where it is today with how positive the real rates of return are in the U.S.
So what's supporting gold then, Frank?
I think a lot of it is out of China. I think that the economic prosperity. Now, what we're in a conundrum, you'd call it, because the PMIs, which drive the demand for iron ore and for coal and for steel and for all that, that's all slowing down because you see the PMIs out of China slowing down. But the stock market's been on a tear, and they're doing everything to create economic prosperity. And so there's another economy growing in China, and that other economy also buys gold, and that affects the love trade. So you're still seeing good, healthy demand coming out of China.
All right, Frank, but there could be other elements also supporting gold. Let's get to our OT segment now. Opportunities and threats. Starting with opportunities, Greece back on the front burner here. They had talks this weekend with the IMF and EU officials, and according to media reports, the talks are not going well. Could the situation over in Europe be helping to support gold prices?
No, I don't see. When we look at Greece, the big risk there, Danielle, is the collateral borrowings that they have from French and German banks. So it's something that if they default, it's going to have a bigger impact on the banks in France and Germany and Belgium, etc. So that will be short term. The euro will fall to 85. There'll be a crisis with it. Gold will hit all-time highs in the euro, and probably at that point we'll get a bottom in the euro.
And looking at the threat side, Frank, it seems to be just a question of the U.S. dollar.
I think that's the real key part, because there's that relationship of the dollar to gold is inverse, and what drives the dollar are real interest rates. That is, what will the government pay you for a 5-year and a 10-year government bond? Take away the CPI number, and you have a real rate of return. This big run that we've had for the past decade is predominantly negative rates, but right now, the U.S. has the strongest positive real rates return for 5-year and 10-year government bonds, whereas Germany, Euro, France are all negative. Japan is negative. So I think that's what makes the dollar stealth, and they don't have to raise interest rates and still remain the strongest currency.
So you're still sticking to that, Frank? I know you've said this since the start of the year that you don't think the Fed will raise rates this year.
Yeah, I don't think so. I think if it does, it'll just really dismantle the export industry in America and make it more disruptive. But we'll see how it unfolds. But whatever it happens is people have to take a look at gold in euro terms is very, very strong. In Japanese yen terms, very strong. Indian rupees also very strong.
And one last thing before we get to your touchdown pass here, Frank. What about the correlation between crude oil and the U.S. dollar? If we see a bottom here in crude, does it mean a signal that we have a top here in the U.S. dollar?
I think that the bottom in the price of oil appears to be strong demand coming out of China. They're paying a higher price now to Saudis for the oil. I think that's been more of a factor of global economic activity. And we mentioned this before, that it takes about 6 to 9 months from a shock like oil falling so much that all of a sudden it generates wonderful global economic activity. And that drop is about a $500 billion global tax break, and particularly for emerging markets. So we're now going to start seeing the fruits of oil falling from 6 months ago, and in the next 6 months will show up in much stronger economic activity out of emerging markets.
All right, Frank, your touchdown pass for the week.
Well, it's going to be the flash PMI. Flash PMI of China is so key for looking at resources, and it has another significant impact on gold and copper, etc. So I think that that's the key part. And in the capital markets of looking at equities, I think the big pushback against Barrick is the big news on compensation. I think in the mining space, that's what's very important, from the big cap of seeing pension funds, etc., protesting on the rewards that are going to management.
Frank, thanks so much. We'll see you next week.
See you soon.
And thanks for watching this edition of Gold Game Film with Frank Holmes. We'll see you tomorrow.